Today we'll be covering basics of the four key components of technical analysis. This is your MC for today, as most days when we have our webinar, this is Sri from Phillip Futures Marketing Communications. With me today is our FX strategist, Mr. Yi Jie. He's going to be talking about the four key components for TA, which he feels is very important for TA traders, whether you're beginner or intermediate. And he's going to be covering, how do you identify trends in different market conditions, spotting key support and resistance, as well as how to understand the MACD and RSI, utilizing basic chart patterns, which is always very essential too, and how do you increase your speed by up to 10 times in identifying chart patterns with Autochartist as a new feature which we recently added to our Phillip MetaTrader 5. Alright, so without further ado, let me hand the reins over to Mr. Yi Jie to walk you through basics of the four key components of technical analysis. Mr. Yi Jie, please.
All right, thank you, Sri, for that extremely kind introduction. So I just want to say thank you, everyone, for taking your evening to be here with us as we explore together the few key components of technical analysis, right? There will be four key components which I will be covering today. Sri has given a really good summary, so out of which the things which I will cover will include trends, key support resistance, MACD RSI, as well as how do you utilize chart patterns in your trading. Right, some of these topics can get extremely technical, but I will do my best to keep it interesting and lighthearted so that you may enjoy this presentation. And my hope is at the end of this, no matter where you are in your trading, you will be able to receive some good value out of this presentation. Right, before moving on, just want to jump straight into this disclaimer, right, to say that this presentation does not take into consideration any type of investment profiles, nor does it constitute investment advice. So if you wish to trade, do your due diligence and seek an investment advisor. Right, so the very first key thing that I would like to cover, just a background of what technical analysis is about. So technical analysis are adopted by this group of traders known as the technical traders. The function of technical analysis mainly is to forecast future price movements based off an examination or analysis of historical price movements, right? So the key thing that technical traders look to really are chart patterns. And just like weather forecasting, technical analysis does not give you absolute predictions. It does not give you the right answers all the time about future prices, because if that was so, then everybody will go into trading, right? So instead, what it aims to do is to help investors or traders anticipate what is likely to happen over time, right? So how do these traders anticipate what is likely to happen? So this is what I'll be covering in my presentation today by using a combination of tools and techniques to help them identify where is this direction of prices likely to go. Okay, so first very key point would be, how do you identify trends? Now, some of you might ask me, why is this important, right? Because if you were to see the assumptions in which technical analysis was built upon, there are three key assumptions, and one of them is that prices move in trends. You can go Google the three assumptions technical analysis was built upon, because today, for the sake of this presentation, we will not be covering that. But that is one of the points, which is why it's so important. So how does it affect you as a trader, right? When you are able to identify trends of the market, what it means to say that prices are likely to move in trends, right? So as we move into the next slide, you can observe that in my slide, there are three directions in which prices are likely to move in: uptrend, downtrend, and range, right? This is kind of intuitive. Some of you might ask, why do I bother to put this into the slide? As simple as it might look, this is an ideal condition. These slides have been purposefully picked to show you a very clear example of what these three directions look like. But in most cases, this may not be so, right? At a first glance, you might not be able to tell exactly which direction the prices are moving, which is why it's so important to have a technique to be able to determine which direction which prices are moving. So now I'm going to cover for an uptrend, what you need to look out for is the forming of higher highs and higher lows. Right, so you see the red circles on the left image of my presentation. How do you interpret this chart? Basically, for a price chart, you look from the left to the right, right? Because on the x-axis, there is time. On the y-axis, these are prices. So prices always move from left to right. So in this case, you can see the HH indicates higher highs and the HLs indicates higher low. So what it means is that as you scan the charts from left to right, you can observe that each peak that is formed is higher than the previous one. Similarly, each trough that is formed is higher than the previous one. So this is how you identify an uptrend. And so to help you to mark this out visually, what you can do is to draw a trend line. For an uptrend, a trend line is identified by connecting three higher lows. Right? In that way, once you glance at the chart, you will be able to tell at first glance that this is an uptrend. Now, for the downtrend, the opposite is true, right? You can observe the formation of lower highs and lower lows in the same way the chart is read from the left to the right. So in order to visually identify this, what you could do is draw a downtrend line. So how do you draw a downtrend line? You connect three lower high points. So that is how you define an uptrend and an uptrend using a methodology that is certain so that you may view them visually. Right, so now we move on to the next way that prices can move sideways, right? Other than uptrend, downtrend, prices can move sideways as well. So what does it mean when prices are moving sideways? It means that there are no distinct direction in which prices are headed. If you look in the image, you can see that prices are bouncing back and forth within a certain range. So the two horizontal lines are marking the boundaries of which prices are moving in. The yellow highlighted area marks the zone in which prices are bouncing back and forth within. So at a glance, you can tell that there is no distinct direction in which prices are moving. So this is what you call a range. Okay, so with that, we have covered the three key directions in which prices can move in a chart. And how do you identify them visually? What are the methods that we use to identify them? So the next key factor that we want to zoom into is how do you spot key support and resistance, right? So this is another important thing that we want to go into, another important aspect of technical analysis. So just a background of what this is about. A support and resistance is like a key psychological level where buyers and sellers tend to react. So how does this translate into your charting? Right, so you will observe an area or a level in which prices tends to go towards and away. Just like the illustration I have on the left, you can see prices are bouncing toward and away to key levels. So the definition of a support is an imaginary floor that prices cannot go below, while the definition of a resistance is an imaginary ceiling that prices cannot go above. Right, so this forms your key understanding of what a support and resistance is about. So in the next couple of slides, I'm going to present to you the different scenarios in which you can identify a support and resistance, both in ranging and both in a trending market as well. Okay, so traditionally, the magic number is 3. When prices have reached the same level 3 times, you would define it as a support and you would define it as a resistance, right? So it takes 3 points to validate a key support and resistance level. Now, the illustration I showed you in the previous slide is based on an ideal condition. Again, it is an illustration to help you understand better what it means. But in most cases, what you would observe would be something like this, where it is not exactly clear that prices do not coincide exactly at the same plane. So what do you do then? So let me just show you very quickly where are the points I've identified, the 2 horizontal red lines. So these are my identified support and resistance. But as you can tell, there are certain areas of the chart in which the prices are jutting out from. So how do you manage that? The way to manage that is by looking at support and resistance as a zone, right? So you highlight the areas in which prices are jutting out from. The best way to look at this is imagine you are drawing a line of best fit. when you learn about drawing graphs, and the line of best fit represents a point or a plane where you can connect the most points together, right? So that is how you first go about to draw your support and resistance, and then continue by highlighting the areas that juts out of that zone for you to identify the key zones. So that is how you manage a non-ideal condition of a support and resistance. So then we have the trending market. How do you go about identifying support and resistance? So usually there are several forms in which support and resistance can take in a trending market, one of which are ascending and descending channels. So if you were to look at the top right image with me, that is a descending channel that traps prices within a band. Usually a channel is identified when there is a upper band and lower band that catches price within a range. So if you would see, there are no prices that goes beyond that band. So in that sense, it forms a strong support and resistance where price cannot escape. Now, if you look at the lower image, there is an ascending channel. Usually that is formed in an uptrend where prices are bouncing to and fro, but in an ascending manner. So the lower band would form what is known as the support, and the upper band would form what is known as the resistance. So that is one way of looking at it, and one way of identifying support and resistance in a trending market. So the next way you can identify in a trending market is also horizontal lines, right? So as I mentioned earlier, that for a support and resistance to be validated, there must be at least 3 coinciding points in a plane. So in this case, you can see that I have highlighted to you using the red circles that there are at least 3 points that are touching the horizontal plane, which I have drawn. And so these points are the support and resistance. So there's another phenomenon that happens in a trending market when you identify these key levels. This phenomenon is known as support turn resistance or resistance turn support. So what do I mean by that? If you were to look at the top left example, the first horizontal level which I have drawn out, the first 2 circles which I have marked out, they are supports, right? Level in which prices cannot go below. So prices come down, touch the horizontal level, and bounced up again. So price rejects that level. Subsequently, in the third circle, you can observe that prices have broken the level and turned back up, touched that horizontal line, and came down. So that is what you call a support turn resistance. So this is a phenomena that you usually observe in a trending market. So vice versa, the other way is also identified in a uptrend market as well. So that is the second way that you identify. There is an exception to this case whereby the highest point and lowest point in a chart is automatically identified as a support or resistance, right? So the condition is that prices must have reversed from this point, right, for it to be validated as a support or resistance. Now we move into the third way that you can identify key support and resistance in a trending market. So this is using exponential moving averages or EMA. So the use of multiple moving average helps you to determine. So what you're looking out for in this case is which EMA does prices tend to fall back into. So I'll just take the left example. There are 3 EMAs. The blue is 50, the red is 100, and the green is 200 EMA, right? The reason why I chose these values is because these are popular values that usually are picked when people use EMA. So in the left image, you can observe that prices tend to fall back into the blue line, right? The blue EMA, which is the 50 EMA. So what this tells us is that the blue EMA is a strong support level, and it tells us that in future, when prices fall back into that line, it is a cue for us to look out for where prices will go to next. And it is highly likely that prices will continue to bounce back up away from that level. But of course, as I mentioned in the beginning, this is not 100% true, but it is likely to happen this way. If you were to look at the right image, you can see also the same configuration, just that it's in a downtrend this time around. you can observe that prices seem to bounce off the red level, right, which is the 100 EMA. And you can see that as prices are going down, it does not move straight down. There are series of peak and troughs because that's just how market forces work, right? So, but what you observe as prices pause and it moves back up again in this downtrend, it tends to hit the red color line. So again, how does this translate into your trading is that once you view that prices are reaching back to the levels of the red EMA or the 100 EMA, it is time for you to be wary that there might be a possible position that you might enter the market into. Right, so I have marked those points that I've mentioned out in the red circles so that you may visualize them. Okay, so the last point of how you can identify a key support and resistance level in a trending market is by means of using Fibonacci retracements. So this is a technique that some technical traders use. Basically, the Fibonacci levels are natural occurring numbers that prices tend to move back into. So these levels are not only observed in the financial markets, but it is also observed in nature, right? So many things are found to follow these key numbers or ratios. So the ratios are as follows: 23.6%, 38.2%, 50%, 61.8%, and 100%. So if you can observe with me in the circles that I've marked out, you will see that coincidentally, the turning points of these charts are all located at these key levels. Right, so there's another method for you to use in a trending market as you identify support and resistance. So I've covered 4 methods so far that you can use in a trending market. Right, so now I move on to understanding MACD and RSI. So why I have chosen this instead of any other indicators, right? Because these are most commonly used or the popular indicators that people start out with. So I want to debunk a myth or a misconception that people usually have when they begin in technical analysis. A lot of people think that there is that technical indicators are an holy grail to trading, that as long as they find the right indicator, they are on their way to making profits. But I just want to caution all of you out there who are starting out that is not true. Trading, for technical analysis to work out, there must be a combination of several factors. The factors in which we are covering today, right? First off, we have trends, and then we have key support and resistance, and then we have indicators. All of this must be telling you a story, a consistent story, must be painting the similar direction in order for your view to be validated. So it is extremely risky to determine a position just basing it off technical indicators. Right, so what is a technical indicator? It is, for those of you who are interested, it is a mathematical calculation. So all of this actually has a formula behind it that is based off historical prices. It measures a specific component, right, of the current price behavior. And of course, its aim is to predict future price movement. So as I mentioned earlier, it is used as a trigger for entry or exit, not to be used alone, but in tandem with the various factors in which we have gone through and will continue to go through in the later portion of this presentation. Now, for both MACD and RSI, they are known as an oscillator, right? They are the most commonly used technical indicators. So some features that these oscillators carry is that they have bands with 2 extremes, an upper band and a lower band. So they are mainly used to identify turning points, and again, it is used in conjunction with other tools to affirm its projected direction. So you can see an image of a pendulum swing. The reason why I've attached that is that every time you release a pendulum, there is an extreme on each end in which it swings to, right? There's a limit. And so essentially that is how an oscillator works. It aims to tell you where are the extremes so that you may look out for it and you may plan the position in which you project. Okay, So a little bit more about what RSI is about. The full name of our RSI is Relative Strength Index. What it aims to do is measure the speed of change in prices over a selected time period. So this could be 7 days, 14 days time period to identify things like overbought and oversold conditions. So these overbought and oversold conditions are the extreme bands in which I'm talking about earlier, right? When it reaches an overbought condition, what this means is that prices tend to turn back down. And when it's an oversold condition, prices tend to turn around and move back up. So essentially, it works something like a speedometer, right? When you look at your speedometer when you're driving, you can tell the speed in which you're going at, and more importantly, how fast you are accelerating. So this is what an RSI aims to tell you so that you may project your future direction. Okay, if you were to look at the bottom area of the screenshot, you can see that that is the RSI indicator. So the two key levels of the RSI is the 30 level and the 70 level. 30 usually indicates oversold and the 70 level indicates an overbought condition. So I just bring your attention to the area where it's marked out by the red circles. So as you can tell from the indicator, it is approaching overbought conditions, right? The RSI, the red color line is approaching that key level and prices are at a peak. So you can see what happens after that. As prices approach the level, it reversed from there, right? So that is the overbought condition. Once prices reach that level, it turned around. So now I bring your attention slightly further to the right, marked out by the green circles. In the indicator, you can observe that prices are reaching the oversold condition. So in this oversold condition means it reached the 30 level. In the price charts, it's reflected the same way. Prices reversed thereafter to the upside. So that is how you use an RSI in a nutshell. Again, these are examples that are handpicked. So it is handpicked to work in the way that I desire, but it is meant to be used in tandem, again, I say, with the rest of the indicators or the methodologies which I'll be sharing with you later on. Okay, now moving on to the MACD. So the full name of MACD is Moving Average Convergence Divergence. Now there are two components with this indicator. There is the MACD line and there is the signal histogram. So what it does is that it helps you to identify the strength of a price momentum in a certain direction. So I liken this indicator to an arm wrestling match, right? Just by observing the competition, you can tell who is the stronger opponent by telling how far the hand is leaning to one direction and how fast it takes the hand to lean in direction, right? So there's momentum, there is strength. By viewing these two components itself, you can tell who is the stronger opponent in an arm wrestling match. So that's what the MACD aims to do, right? So there are two ways in which MACD may be utilized, one of which is with reference to the zero line. So I bring your attention to the MACD indicator located at the bottom portion of the image of the screenshot that I've taken. So right where a horizontal line is crossing in the indicator is the zero line, right, where there is a separation of the green box and the red box. So in the middle of that is the zero line. So how you use this is that if you observe the MACD line and the signal histogram, so maybe just for reference, the MACD line are the red dotted lines and the signal histogram are the grayed out bars that you observe in the indicator area. So if you observe both of them to be below the zero line, what you can tell is that the bears are stronger than the bulls. So the reverse is also true. If you observe both of them above the zero line, what you can tell is that the bulls are stronger than the bears at that point in time. So that's the first way that you use this indicator. Second way that you use this indicator is the relationship between the signal histogram and the MACD line. So in the scenario where the signal histogram is larger or longer and taller than the MACD line, what you can observe is that the prevailing trend is strong. And the reverse is also true. When you observe that the signal histogram is lower than the MACD line, what you can tell is that the prevailing trend is starting to weaken and may even be a signal that a reversal is coming. So let me just illustrate to you the conditions. So I bring your attention to the first red rectangles on the left. What you can observe is that in the MACD indicator, both the MACD line as well as the signal histogram are below zero, below the zero level, and you can tell that prices are moving down, right? So this shows that the bears are stronger than the bulls. And I bring your attention towards the right on the second green rectangle. You can see that on the MACD indicator that both the MACD line and the signal histogram are above the zero line. So this tells us that the bulls are stronger than the bears. And so it is reflected in the chart that prices are moving upwards. So the second example where both are compared to one another is as illustrated in the first on the left green rectangle, where you can see that even though both the signal histogram and MACD line are above the zero line, you can observe that the signal histogram is shorter than the MACD line, and it is below it. And so what this tells us, as I mentioned, is that the prevailing trend is weakening, right? So you can see that as a result, prices are turning back down. So these are the two ways in which you can use the MACD indicator in tandem with the other factors that helps you to validate your projected direction. Now I move on to the fourth component of my presentation, which is how you can utilize chart patterns in your trading. So this segment is going to be a little bit dry. There will be a couple of repetitions because these are classical chart patterns that you will identify. So this information can be found, in fact, anywhere. You just have to Google it. But for the sake of today's presentation, I will give a breakdown of how you can actually use these patterns. Right? So the patterns in which I will cover today are the various ones that are reflected in the slides: the flag, the pennant, the triangle, channels, the wedges, rectangles, head and shoulders, top and bottoms. Right, it is a long list, you get the point. So these are the patterns in which I will be covering from this point forth. So the first example that I'll be showing you is the flag pattern. Some characteristics of this flag pattern is that you will observe it is formed after a sharp spike to the upside or a sharp spike to the downside, right? So this forms the pole of the flag, right? With every flag comes a pole, and this is indicated by the sharp spike to the upside or the downside. And subsequently, after the formation of the pole, you will start to observe that prices will trend lower if the pole is to the upside, and it will be higher if the pole is to the downside, right? So you can tell on the left image there is a spike to the upside, so that's the pole that is being formed, and the flag that's being formed, you can tell it is slowly starting to trend lower, right? So the reason why it is called a flag is because it resembles a flag, right? So that's how the name of the pattern is derived. So another thing to note is that as prices start to trend higher or lower, it is captured within a channel. The channel will indicate to you the formation of a flag. So this is usually seen as a continuation pattern. So what this means is that after this pattern is formed, prices will tend to move back in the direction which it was previously. So in the case of an uptrend, it will continue to move up after this flag pattern is completed. In the case of a downtrend, prices will continue to move downwards after the completion of this pattern. All right, so next we move on to a pennant. So the pennant is similar to the flag pattern in the sense that there is a pole that is being formed initially, right, either to the upside or the downside, depending on the trend of the current market. So after the formation of the pole, what you will see is the similar thing, the trending either higher or lower. But the key difference in a flag and a pennant is that prices will start to form a symmetrical triangle. It will trend sideways instead of upwards or downwards. So this may be marked out using a pennant, so a triangle that meets at its end. So after the formation of this pattern, it is also recognized as a continuation formation. So what this means is that after the completion of this pattern, the price will continue to move in its initial direction, right? So usually in a trending market, prices do not move straight in one direction. So usually it continues, it starts with an impulse, and then it rests for a short period of time. It consolidates or begins to move slightly downwards, and thereafter moves in its initial direction again. So this pause may be captured in these various methods. So first one which I've covered is the flag. The second is pennant. Right, now we move on to the third pattern. Just to give some context, the reason why I'm covering these chart patterns is it serves as a trigger for you to enter your trade. And towards the end of this presentation, I will also be sharing with you a crucial software that can help you speed up the way that you identify these patterns, right? That takes away the manual labor that you will usually do to identify these patterns all in one go. It is by using this amazing software known as Autochartist, which I will share in more detail later on. Right, so the ascending and descending triangle is formed in such a manner that there is no pole. That is the difference. It is formed using two lines, one horizontal line and one trending line. So I think the reason why it's called ascending or descending triangle is quite self-explanatory. You can observe that the line that is at an angle, the trend line, is slowly moving towards to meet the horizontal line. Right, so as the chart patterns begin to move in such a manner that the troughs and peaks begin to decrease in size, and that is where the lines will meet. So this is also generally considered as a continuation pattern, which means to say that if it began with an uptrend, it will continue to move in that direction, and similarly if it's moving in a downtrend, at the completion of this pattern, it will continue to move downwards. So there are two kinds of patterns, usually known as continuation or reversal. So the first three I've covered so far falls under the category of a continuation pattern, where after the formation of these patterns are completed, it will move in its initial direction. Now we move on to the channel. So this is actually very similar to what I've covered earlier on in how you identify support and resistance in a trending market, right? It is formed mainly using two trend lines, a main line and a channel line, which acts as the support and resistance. So it connects 2 to 3 points, which forms the uptrend or downtrend channels. And then this channel line, the guideline is that they must be drawn parallel to one another. Right, it can only be considered a channel if it is parallel. If there even is a slight angle to it, it may be considered a wedge or an ascending or descending triangle. So these are some minor subtleties that you have to learn to recognize along the way as you identify your chart patterns. Now we move into the next pattern, also known as a wedge. So a wedge is formed when prices are moving within a narrowing range that may be identified similarly using two lines. You'll recognize that in most of these patterns, the use of two lines is key to capture these patterns. So the ones that I've covered so far are using two lines. So this is the same in wedges, where it forms a pattern or a shape that is similar to a triangle, except it is pointed in an angle. Right, so the falling wedge is pointed downwards and the rising wedge is pointed upwards. So now I mentioned that there were two kinds of pattern earlier. One is the continuation pattern, one is the reversal pattern. So this falls under the category of a reversal pattern, where the completion of this pattern will lead to price moving in the opposite direction of its initial direction. Right, so at the breaking of one of the lines or the breaking of the formation of the wedge, prices will move in the opposite direction. The next pattern I want to touch on is rectangles. So rectangles are pretty straightforward to observe. So it is formed using two horizontal lines that connects significant point of support and resistance. So if there ever come a scenario in the markets, or as you observe the price charts, a very narrow range, usually that is where you identify the triangle, right? So in terms of price action, what does it mean? It means to say that there is a little game of tug and war between the buyers and sellers, where there is an indecision, where the market does not know where it wants to be, whether it should continue to move up or down, which is why prices are bouncing within this extremely tight range. And so the special point about this pattern is that it can serve both as a reversal and a continuation pattern. You just have to observe the direction in which it breaks. But what you can be sure of is at the breaking of such a narrow range, prices will tend to accelerate in the direction of the breakout rapidly. So there is a huge price movement that you can capture potentially when you observe this pattern. Now, head and shoulders, I think this is one of the more popular chart patterns that you can observe. Slightly complex but extremely intuitive as well. The formation is not formed so commonly, right? But once it is formed, it is extremely easily identified. The components of this pattern is that there is one left shoulder, one right shoulder, and a head. Fairly simple, right? So this formation can happen in both directions, which is why there is a segregation between the top head and shoulder and the bottom head and shoulder. Right? So upon the breaking of the neckline, right? So what the neckline is a point where the two shoulders are resting. Right? The two shoulders are resting upon, and upon the breaking of this neckline, that is where the pattern completes and will begin to move in the direction that it wants to move, which is opposite of the current price movement, because it is known as a reversal pattern. So you observe, just taking the top head and shoulder as an example, so you can see the left shoulder being formed, price bounced off the neckline and moved to the high side, formed a head, came back down to the neckline again, reversed to form the right shoulder. So once prices reach the neckline again, this is where you have to be, you can start looking out for an opportunity to enter the market, right? Because once price breaks this level again, it will begin to rapidly accelerate in the direction it wants to go. So the same concept applies for the bottom head and shoulder. Now the next pattern I want to cover is the triple top and bottom. So this is fairly intuitive as well, in the sense that you can observe that there are 3 points where prices coincide that seemingly falls in the same plane. And in actual fact, you can use a horizontal line to mark out these areas. Right, so other than using a circle to mark them out, for easy visualization, you can use a horizontal line. So the same goes for the bottom pattern, where you can see that the triple bottom is formed when prices coincide with 3 low points. So this is known generally as a reversal pattern spotted in a long-term trend. So usually you will tend to encounter these patterns more frequently in a longer time frame as compared to a shorter time frame. Of course, this is not to say that exceptions do not happen, but in this case, usually it is spotted in a long-term trend. So now we move on to the double top and bottom. So this is actually, it carries the same concept as the triple top and bottom. Now, just in this case, instead of 3 peaks, there are 2 peaks or 2 troughs that are being formed that defines the double top or double bottom. Right, again, it is seen to be bouncing off the near resistance or the near support. So this is, in terms of price action, an indication that buying or selling power is becoming exhausted. So what happens when prices or buying and selling power becomes exhausted is that prices tend to reverse, which is why it is falls under the category of a reversal pattern. So likewise, this is also tend to be encountered in a longer term trend or a longer term time frame. So in a shorter time frame, it is not as likely that you will see this, but there are exceptions as well. Okay, so now I move on. I have completed the 4 key concepts of technical analysis, and now I've come to this segment, which should pique your interest. It will help you to identify those patterns in which I have shared in the final segment of my presentation. No, that took a while, right, for me to explain, and what more identify manually on your charts. But there's good news, because in Phillip Futures, we have integrated Autochartist with our MetaTrader 5 software. So what is Autochartist? Just a quick background. It is an advanced pattern recognition software, right? It identifies over hundreds of trading opportunities based on things like chart patterns, which I have covered earlier in the final segment of my presentation. It covers complex patterns, right? If you are an advanced trader, and looks to things like Fibonacci patterns, things like ABCD, things like the Gartley or butterfly. It identifies that as well. And finally, it identifies key support and resistance levels as well. So the key thing about this software is that it scans the market around the clock, and it can send push notifications to your mobile phone whenever a new opportunity is being identified. Now, this is extremely valuable, as I mentioned previously, for you to be able to identify the hundreds and hundreds of chart patterns. What you have to do manually is to spend hours upon hours, right, to mark this out using the drawing tools on your chart. And perhaps by the time you're done marking out these patterns, the opportunity would have been over. It would have expired. But now with the Autochartist, what you will be able to do is, in an instant, based on your market watch list, identify all the chart patterns that are happening across the different time frames. So isn't that powerful? So just to share with you, this is how it looks like, the Autochartist MP5 plugin. When you adapt this to your charts, it exists as an expert advisor in your MT5. For those who are familiar, basically it resides under the column of expert advisors. So once you drag it into the charts, you'll be able to see these 3 main components, right? First off would be the market scanner. This is what I was mentioning about. It can replace essentially your traditional watch list. So you just have to add the currency pairs in which you are interested to trade upon. So maybe you are a major trader, you only trade the majors, right? So as long as you add them to your market watch list in MT5, this market scanner will be populated with opportunities that are chart patterns, Fibonacci patterns, things like support and resistance for those currency pairs you are interested in, right? So how to utilize this exactly, I will cover in a moment. I will give you a short demonstration. But basically, to explain further, in pattern details, you can see the name of this pattern that has been identified, the length in which it has taken to form. So for example, right now we are in pound dollar. If you look to the top left hand corner, in the 4-hour time frame. So basically how you interpret this is that it took 31 candles of the 4-hour time frame to form this ascending triangle pattern, and then it moves on to tell you the bias of this pattern. So this one has a bull bias, which means it is postulating for prices to move upwards, right? That is the nature of an ascending triangle. Right, earlier on I mentioned it is a continuation pattern. So as you can see, before the formation of this ascending triangle, there was a burst to the upside. So the final component of this plugin is the chart projection. So you will not only be given the name of the pattern, you will also receive the projection in your charts of how this pattern looks like, where exactly is it located. So you don't have to hunt it down on your own. You don't have to mark it out on your own using drawing tools. This software does it all for you. So an interesting note to take is that you can also observe a gray box at the top of the pattern. So what that is actually is a projected take profit region, right? So based on this pattern, it is projected that prices are likely to move within that area. Of course, then again, this is not 100%. Prices do not always reach the take profit region, but it gives you an idea of where prices are headed to. So another benefit of this pattern that are being recognized is that it is so versatile. Whether you are a trader that trades on pullbacks, whether you're a trader that trades on a breakout, this facilitates to your trading style as well. So upon the identification of the pattern, you can choose to say, okay, I'm going to wait for prices to pull back into the support zone, which is usually marked out by a blue line, before I go in on a long, or I am going to wait for prices to break out above the resistance zone, which is marked out by the green line, before you consider taking a position. So this software caters to that as well. That is not all. If you look at the blue horizontal line, what you can tell is you notice certain writings like next D1, next H4, and you see in the bracket beside it some key numbers. So these numbers are actually pricing levels. So what these blue horizontal lines are, it's actually a volatility analysis. What it does is that it takes the past 60 days of data for this specific currency pair and it measures the volatility in this time frame. So what it means to say, how can you interpret this for your trading, right? So what I can tell is that in the next 4 hours, at least in this snapshot that I've taken, pound dollar will move within the volatility of 1.2961 and 1.3062. How does this help you in your trading, you may ask? So how this comes into play is in the setting of your stop losses. You want to know whether you'll be stopped out. That's always the question, right? Am I setting my stop loss too far away or too near my entry point such that I'll be whipped out by the upcoming volatility? So previously, what you could do is base it on previous structures, like the previous swing high, previous swing low, in order for you to set your stop loss level. But in this case, there is actually a mathematical method for you to set your stop loss, right? So for example, I postulate for this position to be held across the next week. I will not set my stop loss level above the 1.2961 level, right? Because it tells me that the volatility for the next 4 hours is within that range. So what I want to do is set my stop loss below the daily volatility range. So this gives me a safeguard and a rough gauge to tell me how long will I be able to stay in this pattern, right? So the other benefits of this software and how it can enhance your trading is that it is available as a mobile application. So you can download this on your Google Play Store or your Apple App Store. It exists as an application where you can view these opportunities on the go. And what's even better is you can set push notifications for specific currency pairs that you are interested in so that you will not miss the opportunity, right? It also has a risk calculator, right, that tells you at a glance from your entry position what is the risk in pips that you are taking. So for those of you familiar with the MT5 software, what you will notice is that currently when you are about to enter a position, right, you have set your the lot size that you want to be in, you have set the prices you want to go in by, whether as a limit or a market. You will not be able to tell the risk in pips that you are taking. So with this add-on, with this plug-in, instantly before you even enter your position, you are able to tell that. The second value that it is adding to you is for you to select your risk profile, right? Whether you want to set your risk based on the cash amount, based on percentage equity, or based on percentage balance. So this is key. What do I mean by that? So you can observe that there is a stop loss level that you can set. So based on your risk management profile and based on your stop loss level, it gives you the position sizing that you can enter. So instantly at a glance, once you have configured the values in this table, what you can tell is the position sizing that you can enter, so that even if prices hit your stop loss level, what you will lose is only the amount that you have predefined. So that's the second key value that this brings to you. In the final benefit of Autochartist would be the daily market reports. You can subscribe for this up to 3 times a day, it sends you a report before the Asian session, before the Europe session, before the US session. So no matter which session you are trading in, it aims to give you an update of the market, right? So what's covered in this report? It gives you the key price movements for different currency pairs in the session before. It gives you the key economic data releases that will be coming in your session, and it gives you up to 8 technical analysis opportunities for you to consider opening a position in. So it gives you an overview, a clear overview of the market. So no longer will you have to run to different sources, your economic calendars, take a look at different news sources to identify all this information. At a glance in your email inbox, you will be able to receive these up to 3 times a day, depending on which session you are trading. Right, so before I move on into the demonstration of Autochartist, right, I want to share about this upcoming exciting trading challenge that Phillip Futures is organizing. So after listening so much to what I have to say about technical analysis, maybe you are thinking it's time for you to put whatever you have learned into practice. For those of you who have already been trading for some time, maybe you want to put yourself to a challenge. So I think there's no better place than to do it on the MT5 Trading Challenge 2019. So a special feature of this trading challenge is this: in most forex competitions, what you have is top 3 winners, right? So the top 3 winners tend to walk away with amazing and attractive prices, but this is not what we are doing over here in the trading challenge. What we have actually is a predefined equity tier. So you can tell on the right image, there are 4 tiers in total. So just so you may know, the starting equity is at 30,000. So even if you were to make an equity increase of 5% or 1,500, you will already be eligible for the first pricing tier of US $150. So this is all taking place in a demo environment. What it means is that you do not have to spend a single cent to take part in this competition, right? You are able to just register to take part for it. Once you register, either via the QR code that is in the image that you see or the link that is provided below that, you will be given a login ID and password. So thereafter, don't forget to download the Phillip MetaTrader 5, because only if you to download the Phillip MetaTrader 5 and log in using the ID that we give you, then you will be considered eligible for this trading challenge. So this is set to happen in the month of April. There will be 2 rounds that will take place, right? So in these 2 rounds, some questions that you might have is, will I be able to take part in both of these rounds? The answer is yes, and even better still, we will be taking your best result out of these 2 rounds in order to calculate whether you have achieved one of these equity balance tier for you to be eligible for these prices. So now these prices are in cash, which means to say it is fully withdrawable, right? So for those of you who wants to try your hand at trading, for those of you who are new and for those who are seasoned traders and want to put yourself to the test, wants to challenge your trading abilities, you are able to take part in this challenge as well. The final key feature of this challenge is that there will be a daily leaderboard that will be published that features the top 10 traders throughout this competition. So do make sure to sign up for it if you are keen. Right. So without further ado, I will move into the demonstration for the Autochartist plugin. Let me just pull out the Phillip MetaTrader 5 platform. So for those of you who are not familiar, this is how the icon look like. So to ensure that you have downloaded the right platform, this is how it's supposed to look. So now when you pull out, when you enter the application, what you will be able to see is this pop-up window. And then once you enter your login ID and password, you'll be brought to your chart. Right now there's some difficulty for me to see my mouse. It is not responding at the moment, but it's okay. What you are able to see right now on my screen is the market scanner, which I have described earlier on, right? So the way to use this is actually by clicking on one of the opportunities, by clicking on the view button beside one of these opportunities, right? So for example, I would like to see dollar CAD. Okay, it seems to have loaded now. Right, so back to what I was sharing. So over here you can see the dollar CAD being featured, and in the bracket what it tells you is the time frame in which this chart pattern is recognized. So what this tells you is that a triangle pattern is being identified for the dollar CAD pair in the daily time frame. So what I want to do is to click on view. Okay, I'm already at the dollar CAD, so maybe let me select another pair. Let's just say the Aussie New Zealand dollar. So upon selection of that pair, what you can observe is that it brings me immediately to that currency pair, to that time frame in which I'm observing it in, and at the same time, the pattern is already being projected on the charts. Right? So this is the triangle pattern that it has identified for you. So with a few tweaks like minimizing the charts if you would prefer, you can view the pattern in full. So there was another component I was mentioning would be the pattern details. Over here, as you maximize the table, you will be able to see some descriptions. But this is not key because from the projections alone, you can tell the pattern that's being formed. So what I usually do is to minimize this window and move it to the side. So over here, after this projection, you're able to tell that this is a triangle that is being formed. So this is the volatility analysis that has been measured over the past 60 days. So in order to place a trade, nothing changes from the usual way of placing an order. Just head over to this quick select bar, enter the new order action button, and over here you can enter the volume in which you wish to trade in. Right, so just like this, for example, I would like to enter a buy order. This is just for example. I click OK, and I can see immediately I'm in the order. Right, so earlier I was explaining that this volatility helps me to identify where should I place my stop losses, right? A gauge for me. So over here, I can see that there is a day volatility measured at 1.0279 level. So for example, I wish to hold this trade for the next week. So what I would do is to click and drag at the area in which I've placed my trade, release it, select modify and OK. Immediately you can see that my stop loss level has been set. So just like this, I have already I've entered the trade, I have set my stop loss level, and all this is based upon the Autochartist pattern that was being identified. And at the same time, for those of you who are not familiar with MT5, you can see how intuitive it is to place an order to navigate around the platform. So a final note to take before I end this presentation is that earlier I was mentioning for opportunities to be populated in this region, right, you have to first place it within your market watch panel. So what I have done here is to right click and select all, show all. In this case, it is blanked out because it is already in that option, so that all the currency pairs that Phillip Futures offers are within the market watch, so I can see as many opportunities as possible. Right. So with that, I've come to the end of my presentation. If you guys have any questions at all, right, any questions that you wish to ask, you wish to clarify, feel free to enter it within the field that you see on your screen so that I may answer it. Yeah, so any moment right now, if you have any questions, I will be glad to answer them. Okay, over here I see a question from Peter. Peter Lai mentioned, should we include candle wick in the trend line? So this question actually is a very commonly asked question, right? There's many debates going on whether a wick should be considered in identification of trend lines, identification of the highest and lowest point, identification of chart patterns, right? So personally, I do not include the wicks in my trading. It's just a matter of preference. I would say that this is not crucial. So it is completely up to you as a trader whether you feel comfortable including the wicks or not. But what I must say is that if you decide to use the wick, then you should include it all the way. You should be consistent in the way that you identify your patterns. You should be consistent in the way that you mark out your trend lines. So if you decide to include the wicks, you should do it all the way. So that is my answer to your question. I hope it helps to clarify a little bit more. So next question from Henry is Autochartist most reliable on TF time frame? I would suppose hour 4 and day 1, right? So in Autochartist, what it aims to do, I think it is not a question of reliability, but whether it gives you the patterns, whether it identifies for you the different patterns you wish to see. So it does identify on the 4-hour time frame, on the daily time frame, and it also even goes down to things like the 1-hour time frame per se. So if you are still looking at my screen, you can see there are 16 pages of these opportunities for you to scroll through, right? There is the hour, there is the 15 minutes, there is 30 minutes. So I think the thing is that it identifies patterns across different time frames, and it provides for you a visualization. So you can click into the patterns and observe whether it is marked up as you envision it, and if not, how is it marking out the patterns, right? Can you show how the Autochartist is being set up? So I think I've covered how you use it. As for how you can set this up, maybe just a quick demonstration how you can download this, right? So first and foremost, you need to have a MT5 demo or a live account with us in order to have this feature, Autochartist. So once you requested for a demo, maybe just let me take you through very quickly how you can download a demo on our website. So there are a few ways you can do this right now. Of course, using the MT5 trading challenge, you can do this as well. So to register for the challenge, simply head to our website. You can Google Phillip Futures or just enter phillipfutures.com.sg. In the first page in our banner, you can see over here, register now. Right, so once you registered for this challenge, you'll be given an email with instructions to download our MT5 platform. The other way you can do this is by coming over to investors platform, request a demo, right? And over here, as you fill in your particulars, in the same way, you will be given an email with the login details that you need, your password and your login ID. From then on, you will also be able to receive a downloadable file where you can install our MetaTrader 5. Okay, so once that is out of the way, I must say that for the purposes of the trading challenge, if you were to register using this method via the platforms and request a demo, you will not be considered to be eligible for the trading challenge. Only when you register it via the competition page, then you will be considered to be eligible. So just getting that confusion out of the way. For how you can download Autochartist, right? After everything has been set up, the MetaTrader 5 platform has been downloaded, come into our website under Investors, head to Platform and click on Phillip MetaTrader 5. So continue to scroll until the middle portion of this landing page. You will be able to see a header known as Trade with Autochartist now, and under this field you can see MT5 plugin. Right, once you see this, you click here and a whole new page will pop up. In this page, it tells you everything you need to know about Autochartist. There are about 5 tutorials, 5 videos that you can watch that teaches you all the way from how you install the plugin, how you use the market scanner, how you use the risk calculator, and even the mobile application. So if you are not a person who likes video, you prefer a document to refer to, we also have it in PDF. right? So you have the best of both worlds. You're able to view it either in video or in PDF. So once you have viewed all this, you want to go ahead to install the plugin, simply click on this download plugin. Right? Once you click this, simply follow the instructions that you are given either through the video or the PDF, then you will get there. You will be able to have the plugin onto the MT5 that you downloaded. I hope that answers your question. So yep, I don't see any more question that is being posted. If any of you have any more questions, feel free to post it in the question segment so that I may answer you. I understand today what I have covered may be dry and maybe technical. There's a lot of things to absorb. So if you have any clarifications to make at all, please feel free to enter it now. Alternatively, you may contact us on our website, arrange for a one-to-one coaching. So the question that Caitlin, I received a new question from Caitlin, whether Autochartist can be used to trade stocks as well. Unfortunately, right now at this moment, we do not offer stocks on MT5, right? So this will not be able to be applicable on stocks in the current moment. Right, for any more questions, we're just gonna give
we have a query on from Jason Ho asking if we're going to get the slides for today. We have recorded this session, so you can revise what Yi Jie has covered on technical analysis at your convenience once the video is up. Do look out for follow-up email, which we should get to you by tomorrow.
Thank you, Sri. So we're just going to leave this on for a couple of moments, just the last few seconds before we end off this segment, so that you can squeeze in any last questions that you have. Right? Do not hesitate to clarify anything. I do see that many of you are still in this webinar, so if you have questions that you wish to ask, please do not hesitate. We have come to the end of the content that we are going to present, so now it's solely dedicated to the questions that you may want to ask, whether is it regarding technical analysis, whether is it regarding Autochartist, or even about the trading challenge, right? More information about the trading challenge. There are some questions you want to clarify, the mechanics of the competition that you would like to ask about. Feel free to ask them in the chat box in this webinar so that I may answer it. All right, if not, thank you very much for your kind attention today. You have been a great audience. Hopefully, all of you have learned something new today, something that you can use to take action in your trading from this point forth, no matter where you are in your trading, as a fresh trader or as a seasoned trader. Thank you so much once again for attending this session, and we hope you have a great weekend ahead. Cheers.